Investment in knowledge pays the best interest. With this popular quote from Benjamin Franklin, let's discuss the basics of investments to enhance your financial literacy. What are mutual funds? I'm sure the first thing that comes to your mind when you hear the word mutual fund is mutual funds are subject to market risk or mutual funds sahi hai. But today, we'll learn what exactly is a mutual fund. A mutual fund is an investment tool in which the money from several investors is pooled and managed by a fund manager. Let's understand this with the help of a story. Let's suppose there is a kid whose name is Smarty who wants to eat a slice of pizza. Now the cost of this pizza is rupees 300, but this kid only has rupees 50. So what he does is he calls 5 of his friends and all 6 of them pool their money to buy a pizza and enjoy one slice of pizza. They gave their pooled money to a chef who baked a pizza that all 6 of them liked. Mutual funds work in the same manner. Just like the kids pooled their money and gave it to the chef, in mutual funds, small investments from several investors are pooled together to create a large investment fund. This fund is then professionally managed by a fund manager who makes investment decisions on behalf of the investors. Trusting the fund manager with your investment is similar to trusting the chef with the recipe for pizza or trusting to a doctor. You do visit a doctor when you feel sick, right? And take medicines, but you can take the medicines suggested by the chemist also. However, it is always good to trust the experts. Just like there are different types of pizzas and you can enjoy a slice of any type of pizza, mutual funds have multiple types because every investor has different goals and risk appetite. Investors can buy a slice of any type of pizza, and in mutual funds, you don't even need to gather your friends to buy this pizza. You can start investing in mutual funds with as low as rupees 100. Now let's dive in some basic concepts and core principles of mutual fund investing. Diversification. Imagine that Smarty and his friends not only pooled their money to buy a single slice of pizza, but decided to buy different types of pizza with various toppings. Similarly, mutual funds provide diversification by investing in a variety of assets such as stocks, bonds, or other securities. Diversification helps spread risk across different investments, reducing the impact of poor performance from any one investment. Investment objective. Different people have different pizza preference, and similarly, investors have varying financial goals. Mutual funds come with specific investment objectives such as growth, income, or a combination of both. It's important to choose the funds that align with your financial goals. Expense ratio. Think of expense ratio as the cost of making the pizza. It includes the fund's operating expenses, management fees, and other costs. A lower expense ratio can contribute to better returns for investors over the long term. Risk and returns. Just as different pizzas have different flavors and levels of satisfaction, mutual funds come with different levels of risk and potential returns. Higher risk funds may offer greater returns, but also come with potential for higher losses. Assess your risk tolerance and investment horizon when selecting funds. Systematic investment plans, SIPs. Mutual funds give you this amazing advantage of SIPs, which is convenient as well as beneficial in multiple ways. Similar to ordering regular slices of pizza, SIPs allow investors to contribute a fixed amount of money at regular intervals. This disciplined approach can help investors benefit from rupee cost averaging and minimize the impact of market volatility on their investments. Historical performance. While past performance is not a guarantee of future results, reviewing a fund's historical performance can provide insights on how it has performed in different market conditions. However, it's important to consider longer time frame rather than short-term fluctuation. Remember, just as Smarty and his friends made informed choices about pizza pool, investors should research and make well-informed decisions when selecting mutual funds. Consulting with financial advisors, understanding your risk appetite, and aligning your investment with your financial goals are key to successful mutual fund investing. Mutual fund is an investment vehicle that is designed for the layman investors, as they can make the most out of capital markets without you spending a lot of time and effort. You can keep up with inflation and achieve your long-term goals with disciplined investing in mutual funds. So this will be it for the first chapter of Investment Academy. We will be learning a lot more about mutual funds in the upcoming episodes of Bullsmart Investment Academy. Mutual funds are subject to market risk. Please read all scheme-related documents carefully before investing.